Australian dollar comes under pressure as US dollar regains ground.
Federal Reserve, data-driven rate path. HSBC, Indian rupee gives back major early gains while approaching closing bell. Crypto today, Bitcoin, Ethereum, XRP extend decline amid renewed risk-averse sentiment. UK stocks, turning in mixed performance.
WTI stays lower near $78.50, ahead of US-Iran. Peace talks 2 points euro. US Farm Agency staff warn trade, research, aid programs at risk from reorganization.
Exclusive Chinese state traders make large US soybean purchases.
Gold firms slightly amid drop in oil prices, weaker dollar. Gold struggles to hold gains amid mixed US-Iran headlines, hawkish Fed. Australian dollar comes under pressure as US dollar regains ground.
Federal Reserve. Data-driven rate path. HSBC. Indian rupee gives back major early gains while approaching closing bell. Crypto today. Bitcoin, Ethereum, XRP extend decline amid renewed risk-averse sentiment. UK stocks turning in mixed performance.
WTI stays lower near $78.50 ahead of US-Iran. Peace talks 2.0. US Farm Agency staff warn trade, research, aid programs at risk from reorganization.
Exclusive Chinese state traders make large US soybean purchases.
Gold firms slightly amid drop in oil prices, weaker dollar. Gold struggles to hold gains amid mixed US-Iran headlines, hawkish Fed.
Japanese yen. Joint intervention supports yen outlook. MUFG.
Yen climbs for third straight session. Euro-dollar awaits US data.
Good morning. All right, getting close. 16 seconds. Yeah, boy. Okie dokie. All righty. Boom. Yeah, boy. Hey, hope you had a wonderful weekend. Welcome to Forex.Today, the YouTube community of more than 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Because trading is risky, it's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So, hey, we got an interesting world going on. Markets are up, down, and sideways. There's so much to cover. We got news coming out, ending the week with non-farm payrolls. That's a pretty big deal, right? But one of the things I heard today was the Japanese yen has been strong for 3 sessions because now there's worries about intervention by the central bank, because strong yen means central bank intervention. Is that true? I heard it from like Bloomberg. I heard it by fxStreet. Is it true? No. That's extraordinarily superficial. So, what happened last week that would have triggered Japanese yen about 3 trading sessions ago? Something we had in our playbook as far as the logical intelligence response based on human behavior, activity, and of course, the study of economics, which is the study of scarcity. What is the truth? Remember, eating a lot of ice cream does not make it hotter outside, even though when it's hot outside, ice cream sales goes up. There was a massive earthquake. Now, if you go back to training I gave 10 and 15 and 20 years ago, you've been trained to develop a playbook that says if there's a major earthquake in Japan, that the Japanese yen is going to get strong because most of the investments by Japanese investors are overseas to catch higher yields. And then suddenly, with the major earthquake, Japanese society will need more yen to repair their homes and businesses, their schools and their roads, put back together the bridge and the tunnels. So suddenly you need access to cash. Most of that cash is overseas because of the low interest rates in Japan. So they bring that money home because there's suddenly a scarcity of money and an increase in the demand for money. The Japanese yen goes up. We talked about it 20 years ago, 15 years ago, 10 years ago, even 10 weeks ago. We talked about creating a playbook, a contingency plan. And one of the things in that book that you should write down is if there's a major earthquake in Japan, buy the Japanese yen. So this is why knowledge is power, because if you paid attention to media, they give you some other weird, reality. Oh, it must be central bank intervention. Oh my God. No. Now, we can also, you should be in the habit of not knowing everything, right? You should be able to at least plan some things. Sorry. We'll look at Euro Yen. And boop, 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 boop. Or Pound Yen, we can take a look. Yeah, that's kind of, and then Aussie Yen, is that gonna be in there as well? I'm just double checking that they're all kind of in there. Like Aussie Yen falls almost 4%. What is this? Pound Yen? Sorry, I'm looking at 10 things. Yeah. Pound Yen drops 1.5. Euro Yen drops 0.5. USD Yen, that's probably pretty balanced. Yeah, it's totally flat. That's what I would expect. So what I'm trying to get at is somewhere in July, okay, somewhere in July, this is, I don't want USD Yen because I would expect that to be flat, just out of its history. So where do we go back? Aussie Yen? Pound Yen? And we'll use Pound Yen. Hey, someone's got a hot mic. Can you double check? It might be you. So we go to monthly analysis, and we're in a period of Pound Yen falling, as an example, which means it's absolutely, totally normal for the yen to be strong. Dan the man, you have a hot mic. I got it. It was you, Danny boy. So anyways, how cool is that? Do you feel powerful when you have knowledge and you say, hey, I heard CNBC say this. I heard Bloomberg say that. I hear FX Street see something else. And then I hear an expert on YouTube. And they're all spouting out BS because they don't know. And we can just know the facts. You're like, oh my God, well, the yen always gets strong, or let's say over 20 years of statistical analysis on a weekly basis, broken out into monthlies from weekly data, it's absolutely totally normal for the Japanese yen to be strong right now. And it'll likely continue to be strong. But on top of that, there was a massive earthquake, which would increase the demand for yen. And the value of the yen would go up. And this is, undergrad, foreign exchange work if you study economics, right? Every undergrad economics student does the supply and demand of money. And so it's just like, oh, the yen goes up in that situation. Plus, it normally goes up anyways. And so we're like, oh, well, if you didn't listen to the news, if you didn't listen to Bloomberg, or if you didn't read things on FX Street, if all you did was have the data, you would not even think, oh my God, it's the central bank cornering the market and pushing up the value of the yen, defending some level. Now, maybe they are, but it would be very difficult to get to that conclusion unless it's extraordinarily different than normal. But if the yen is strong now, and the yen is usually strong now, and there's an event that would likely create it to be strong now, on top of all of that, it would have to be extraordinary strength in the yen for it to be central bank intervention. Now, maybe it is, but I need you to, first of all, not just jump to conclusions, but understand the path to through the logic to a reasonable conclusion. And that makes you smart money. Right? Yeah. But granted, probably central bank intervention panic sells more newspapers than someone coming out going, hey, did you know 80% of the time in the last 5 years, the yen is down 80% of the time? So is it central bank intervention? Okay. 60% of the time, euro yen falls in August. Is it nice to know that? 60% of the time, your USD yen falls. Be nice to maybe get some more yens on here, huh? What about crypto? We've already made all these trades. Do you guys remember our analysis? I'm not going to say prediction, but our analysis said, hey, over the last 22 years, or over the last 20 years, Ethereum goes up 22%, but Bitcoin goes up 7%. Can anybody confirm this, just in case somebody new is logged in? Right, those are pretty bold statements to say, hey, I know Ethereum has fallen for 2 months in a row, but this month it's going to go up 22%. And then the next step is to confirm that we already knew August would be down, even though Ethereum should go up. Massive increase in value in July for Ethereum, not in August, right? So July extraordinarily good, August not. Can anybody confirm that? So now we got to check and see how we did, because when I go to position trade here, it shows you how much the assets have appreciated or depreciated in the last 30 days. And Ethereum did very, very good. It ended at 15, but remember, it was 23. Bear in mind, these are swings inside of a month. It doesn't have to be the 1st to the 31st. If you knew there was a high probability of Ethereum appreciating by 23%, and then you did nothing about it when it was up 23%, I'd have to ask you, like, are you not happy with a 23% month? You thought it might go to 50. Did you do technical analysis? Was hope your strategy? Like, did you not manage the money? Did you not take your profit? Did you not rotate? Like, if you had a high probability of 23 up and then the next 6 weeks was down, 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 did you at least exit the long? Did you even think about maybe the short? I'm not saying you have to, but did you think about it? Did you hedge if you wanted to stay long-term long? Or are you just observing? Are you a lurker? What's your strategy, right? Matthias says, what is the reasoning behind tracking the COT? Really? Do you want to know if large institutional investors are buying billions and billions and billions of the asset that you're trading? Would you care if you found out that you were long, but they were selling billions and billions and billions and billions? Yeah. Now imagine, Matthias, you take it to the next level and you have seasonality to say, well, usually the asset appreciates now and then falls later. And then you track what the institutional investors are actually doing. And are they buying on the way up? And when you get close to the seasonal pivot, do they start dumping their positions? It's extraordinary for measuring things like tops and bottoms in the market. And when you combine that, there's three things you should combine, right? Seasonality, COT, and then technical analysis. Because if you thought a top was coming and you can see the positioning by institutions at or near the top, and then you see the change in positioning from buyers to sellers at a predicted seasonal top, and then on your charts you saw lower low, lower high, dude, game on. Okay. It's crazy powerful. Or Matthias, you just do what retail Forex traders do, and they just trade a moving average crossover, or they trade an oscillator crossover, the signal, or they do a London breakout strategy, and they have no understanding of context or rationale, or even like, is this trade worth 50 pips or 500 pips? They have no idea. And that's why it's nearly impossible to succeed. Now, you might get one or two guys that can do it, but even that is doubtful. Yeah, but Matthias, now you're thinking in the moment. You're not thinking, Matthias, think of it this way. If you knew institutional investors were likely to sell for 12 weeks, and then you start tracking that they have started to sell, now your trade is not worth 50 pips, but it's worth 500 pips or more. It could be worth 1,000 pips to let the winner run. So you're like, well, if the data comes out on Friday and the trades actually happen Tuesday, it's 5 days late. You're thinking way too small, quote unquote, way too retail, which is not an insult. It's just that's what that is. But if you can add a little more institutional flow to your analysis, you can say, hey, technically this trade looks the same as every other trade. You took a 21.55 cross and then you're selling a lower high. Great. But because of this bigger data, you can say, well, what's the probability of me going for, let's say, a daily pivot? Or maybe I should go for a weekly pivot. Or maybe I should go for a monthly pivot. Or maybe I should go for an annual pivot. And you have the strength and courage to let your winners run. And I'll remind you, my personal opinion is that you'll never get filthy, stinking rich unless you know how to let your winners run. Now, you can play around skippity-scalpy all day. Mathematically, it doesn't make any logical sense. It's trading under fear, or you're just purely admitting that you have no idea of what the value of your trade is, whether it's measured by 50 pips or 1,000 pips. You have no idea. Every scalp is the same thing. So you're in and out in less than a day, maybe less than 4 hours, maybe even less than 1 hour, because you have no capability, you have no framework to say this one's going to run for 5 weeks. So what happens is every single trade you make is not worth much. It's just not worth much because you don't have much data behind it. And you don't know context or magnitude. You don't know to scale up. And maybe this is one of 50 trades over the next 5 weeks that you're going to compound. You don't know how to like place your stop loss. You're like, well, I'll keep my stop tight, which is almost guaranteed to lose. Like there's just, you have to understand value and context, right? Like all we have on your chart is price and time. So when scalping is nothing but time, but you have no value attached to the trade, you're like, well, I'll make money in the next 20 minutes on this trade. Really? Why are you so afraid? Why are you only in the trade 20 minutes? Well, I'm up 20 pips. I'm like, why? Is 20 pips important to you? Yeah, well, I got 9 standard lots on it. You are not trading properly. I'm not saying that's you, Matthias. I'm talking to everybody. And I think for those that are doing those types of trades, they already know this, but they're living quiet lives of desperation. They got to get rich, and they got to get rich now, and they're focused on trading big money for small moves instead of actually creating a value proposition for a sustainable business that harvests. I want you to harvest pips. I want this to be like math, like engineering to you. And if you look at it that way, like go meet someone that trades $1 billion in Forex. They're engineers. They're not wild cowboys trying to get rich quick, dude. Okay? So you got to think big. You got to think mathematically. You got to engineer your money and not hope and pray and gamble and all that kind of stuff. So again, because we know last month we saw Ethereum. Of course, we don't know. We just have math that suggests based on historic norms, which we could just call probability. There was a very high probability that even though Ethereum was down for a few months, that for some weird reason, it was going to be up huge in July and then give it all back. And we talked about it at the beginning of July. We even talked about it in June of having a great Ethereum month. And then if you didn't manage the position correct, you would give it all back. That's pretty good info, right, Matthias? And then you combine that knowledge with we got it from seasonality, but now then you can combine that with things like the COT. You combine that things like that, like with the commitment of traders report or the charts or a bunch of other things, right? Yeah. Let me get out something here, and let's just see. Crypto. And where she be? So Bitcoin, Litecoin, Ethereum. Okay. Let's take care of that. Let's just reset this. We are on monthly, right? Let's do so in July we were bullish. So you want to go to pivot points, monthly, sorry. Position trading. Why can't I find it? Okay, bullish bias. Okay, so we didn't get to our target. Okay, so where did we get? So now let's change it again and go monthly. It'll show all the pivots. Okay, so we just kind of, the pivot strategy is here to here if you're a bull. That's the projection. We got up to R1 and then it kind of just fizzled and faded out and we just ran out of time. But notice that when we got to here, that was when Ethereum was up 23%. And we were talking about at that time, like, hey, isn't it interesting? We thought Ethereum would be up 23%, and it is 23%. Now, it still could go that high, but 23% is 23%. But we also know sometime by the end of July and down into August, and then maybe as far as September. So again, going out to Matthias here, research may show that sometime by the end of July, it's going to no longer be bullish and then fall, and maybe even fall more than that because it could fall not just 4 weeks, but 6 or 7 weeks. So what we said in July is, yeah, you're going to have a monster move, but at some point, if you don't manage this properly, you will give it all back. Not that we know you will for certain. We just know probability. You're probably going to give it all back if you just hold on. That's not a strategy. Hope is not a strategy. So at some point, does your technical analysis tell you that this uptrend is over? How about 100% pullback? How about a lower high on the last day of the month? Now, what's the technical strategy for August if you are now a bear? Remember, you were a bull in July. You are now a bear in August. What's the trading strategy? Well, if you're going to use monthly pivot points, 1920 down to 1492. That's just our version of implied volatility based on what happened in July. That's what's likely to happen in August as a bear. And this goes back to our conversation 5 weeks ago of giving it all back. Now, do I think that's actually going to happen in the month of August? No, but that's me guessing. But between now and let's say the middle of September, oh, for sure. So if I were to guess, I think the summer's going to be boring. We can have an inside week. And then we have a terrible September. And yeah, we do give it back. So we get down to 1,500 by the middle of September. But the thing is, at least it's hypotheses based on rationality and probability and historic norms. And now I don't know if that's right. I don't even know if it's close to right. I just know it's very often somewhat correct. So now I use my brain and my technical analysis to confirm or deny that hypothesis. So if this sucker takes off and instead has a bullish August, I could see it happening. Maybe I even want to trade it, but I would know it's extraordinarily unusual and that I should treat it accordingly. Should I be long-term long and strong? Not when it normally is a depreciating asset. I don't want to be long against historic norms. I don't want to be long against institutional investors. I don't want to ever be contrarian. Now, maybe you like to be contrarian, but if you're going to be contrarian, shouldn't you know you're actually being contrarian? Like, how do you know you're contrarian if you don't know what other people are doing? So you have to understand our analysis now is legal and ethical inside information, because we can see norms, but we can also see what other people are doing. If you consider an institutional investor with billions of dollars online a real people. Now we can pull and extract retail positioning, and we do put that in here, but the main focus is institutional positioning. Yeah. So back in July, when we said Ethereum should be bullish, look at all the long positions. So I think what Matthias is saying is, hey, well, next week we expect this to be red, but right now it's green. So is this worthless information? No, you need to think longer than even a few days. So now you're like, well, I don't know if I'm still bullish. In fact, I might actually be bearish. So now, right, on Friday after NFP, if you see suddenly nothing but red on the screen for crypto, okay, now you know they're short-term little buying. Like, how about this? Let's reverse it. I was just going to say, if suddenly this is all red, you see that they've taken their profit, right? And now they're bearish and they're supposed to be bearish. But think of it this, let me back out and start again here. Our assumption was cryptocurrencies were going to go up for a month after being bearish for 6, 7, 8, 9, 10, 11, 12 weeks in a row. 1, 2, 3 months in a row of just bloodbath in currencies, in cryptos, right? But for some reason, we have the audacity to be long in the month of July. In fact, heavily long on Ethereum. We knew Bitcoin was likely to go up 7, and our assumption was Ethereum will be 23. So we're like, hey, if you like Bitcoin, you're going to love Ethereum, but only in that month. But the second thing is you can put it into context. So they were buying crypto in the month of July, but they were heavily short. So how about this, Matthias? What if next week this is nothing but red, and they're already bearish? For those that swallowed the bait and they keep buying more and more Ethereum, even though this is red, and this gets bigger, they think, oh, I'm going to buy the dip because there was a double bottom higher high. So I'm going to buy a dip and get rich on trading Ethereum and Bitcoin. Meanwhile, they're not paying attention that with billions of dollars on the line, institutional investors are hardcore against those guys. So you did well in July. Maybe you got lucky. Maybe you got in late. And that would be the case if you didn't have the data. You probably got lucky or late. But now those same people that got lucky or got late by being long Ethereum and Bitcoin and other crypto, they just found themselves standing in the middle of a landmine. But what if they don't even know they're standing in the middle of a minefield? They don't even watch this data, Matthias. So suddenly everything is red and they're trying to buy a higher low. They're long and strong and they don't know anything about seasonality. They don't know anything about institutional positioning. If you don't know that stuff, you probably don't know much about macroeconomics, probably aren't able to actually quantitatively identify market conditions like risk on and risk off that we do to 2 decimal points. Those kinds of traders just don't know how to do it at all. Those are the ones that are going to put your kids through college. and put gas in your Lambo. Too bad for them. It's not your fault, Matthias. When you're long, someone else has to be short. In this case, you should be expecting this to already be read. You're not looking to this for answers like, should I be buying this week? You should say, well, this was last week. This confirms that the buying was short term for institutional investors. And that if this turns red next week or at the end of this week, right, it's your confirmation the crypto rally ended a week ago, which we already anticipated. We already planned for it. You already recognized it technically. Okay. For example, we're all good at technical analysis. Okay. Okay. Up, down, down, buy, up, down, buy, up, down, buy, up, down, down. So it's barely a higher high, and it's way too low. It's not a lower low, but it's a very low higher low. And then no higher high, no lower low, no higher high, no lower low. Could you draw the MACD on this? Could you draw the stochastics on this? Yes, you should be able to if you know the math. So I can see stochastics rolling over and dying. I can see MACD crossing all over the place at the waterline. Bullish, bearish, bullish, bearish, bullish, bearish, bullish, bearish, but definitely not a trend. And then what? Again, a stochastics rollover, MACD crossover, and then lower low, lower high, lower low, lower high, lower low, low. It died. It's over. If you know basic technical analysis, you're like very bullish. Okay. And then what? Consolidation. Look at it on a 4-hour. Okay. Which is preferable. Bullish and aggressive. Bullish and conservative, bullish and conservative. Okay, now look at MACD dropping like crazy. Little expansion, MACD crazy, flat, drop, bearish. So you can see very bullish, quite bullish. Yeah, this pullback gets you to bullish but neutral. Now you're just neutral, and now you're straight up bearish using technical analysis. But imagine, though, you expected this to happen 4 weeks ago. 4 weeks ago, you expected it to happen. We call it probability. You're like, that's probably what's going to happen. Now, do you know the time? No. Do you know the price? No. That's why we use charts. But in general, up and up 23%. So great. But by the end of the month, you're going to see some form of consolidation. And because in July, you could also see August, you're like, well, by the time we hit August, it should be bearish. So is it going to happen late in the month? Probably. At what price? Don't know. So you don't know the price. Pivot points would suggest we can get to M4 at 2053. Okay, that's based on implied volatility. But what you know is probably by the end of the month. So we get to the middle of the month and you're you're up 23%, just like you thought. Could this be an opportunity to start taking some profit after I'm sure you added 15 or 20 trades here, right? So you start first in, first out, perhaps. And then what? It starts fizzling and fading. Technical analysis should be screaming at you. If you already thought, here's the thing, it's confirmation bias. If you already had the probability of consolidation into reversal, you would recognize this. Your MACD would have importance. Okay? Look at the MACD falling. You're like, Wayne, there's no MACD on your chart. Look, calculate it with your brain. MACD is falling hard and fast, and it just crossed over here. But what's the real indicator is you knew or assumed this would probably happen somewhere around this time. You didn't quite know price, but you knew the percentage change. So good enough for the girls I go with. And then in here, you understand context, right, Matthias? That just this falling MACD is hugely meaningful because you expected it to happen. And now you're like, oh my God, there it is. I should probably start taking profit. I'm up 23% for the month. I should probably book some of this profit because it's probably going to fizzle and fade. And then it's probably going to give back everything, all 23% appreciation over the next 5 or 6 weeks. It'll probably give all of it back. So if you're late, you don't even have the 23%. But also, if you don't have the data, what do you start doing? You start buying the dips. Okay, your plans look like that. Well, let's get rid of this. Boop. Okay, your plan looks like this, or it looks like this, which actually technically is proficient. It might do that, but it probably won't. You see the difference? So where's my drawing tool? Let me make sure I'm clear. This is important. Okay. Delete, and I'll do it in blue. Let's do it in blue. Delete. I said delete. There we go. All right. So if you were a bull, you would trade this for sure, right? That makes sense, right? What if, I'll make up a number. What if, based on data, there was an 80% chance that won't happen? Even though that's technically what it said, but just based on how the market trades this asset, but what if we just knew it probably just isn't going to happen based on human behavior? Whatever the asset is, I don't care about Ethereum. Maybe it's gold, for example. You're like, well, technically the chart looks bullish. It's made a double bottom and a higher high. Okay, but what if there was a 75% chance it's not going to happen because it almost never happens? There's no reason for a human to buy it in that month, but that's what it looks like on your chart. But if it's extraordinarily rare, that's what you're betting on? You want to bet, you want to take long shots every time? You're like, oh, well, there's only a 25% chance this is going to work out, so I'm going to go big. Whoa, 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 whoa. You're supposed to be aligning yourself up with normality. You're supposed to be lining your trades up with probability. I want your trades to probably work. Wouldn't that be nice? So if you were going to do this, you would need to be very cautious. I understand the technicals here. And I'm not saying technicals are wrong. That's not my point either. My point is this looks attractive for sure as a buy zone. But make sure you also know if it usually works. What if that's the right trade, but the middle of September is way better than the middle of August? What if you're doing the right thing, but you're a month early? What usually happens to all of us is that you take a bunch of losses in August. It technically was a perfect trade, but we didn't understand that it was probably not going to work. So we try 2, 3, 4 times, and it just doesn't pan out. So we lose confidence in it. And then by the time we get to the middle of September, we're like, we don't even trade this asset. Trade Ethereum. Oh, it's a dog with fleas. And then Ethereum takes off without you because you had the right idea, but the wrong time. Remember, there's only price and time. So you might have the right price, but the wrong time. I will let you know, sometimes the markets are bullish in the third week of August. And often they do go up, just in general, like every market, like we'll call it risk. Risk on very often happens around the third week of August. And sometimes it goes up and up and up and up and up. I've definitely made trades at the end of August and held to the middle of December. Yes. More often than not, though, they come back, and I gotta try again in September. And it helps handle sort of the psychology and the motion of being a trader. And it allows me to say, okay, what if in the third week of August this year, risk on does improve? The stock market starts going up. Cool. Is it going to last all the way to December, or is it just going to go up for a few weeks and then down for a few weeks? Because that is probable. But sometimes the second pullback in September doesn't happen. Now, when would that when would the shift occur? Well, very often around political elections. So people front run the election in August. They want to get their trades in before the volatility or the lack of volatility in September, October, November around the election. So they're like, we don't know what's going to happen pre-election, so we're going to make our trades now and just be in. Yeah, okay, that would be logical. Do we know if that's going to happen? Impossible to know. But we can track things like COT and see, and if there's unusual spikes in positioning in August, it helps build the case that the mid-August rally, or late August rally actually, is something that can last. So what I like to say is, I like to buy in the third week of August. But if it goes up and then comes all the way down, psychologically, I'm okay with it. So I go for it, but I'm comfortable with break even. It doesn't break my spirit. But the thing is to be in. Now, because my spirit isn't broken, and we get to the third week of September, let's say, and then everything turns green, right? Green on the screen, risk on, stock market up, everything up, crypto's up, gold is up, and all this kind of stuff. Good. And I confirm with these things with daily pivots, weekly pivots. I can confirm it with COT. I can confirm it with, both technically and fundamentally. I'm long and strong. And even though I might have just broken even on 25 trades in August, I don't get all sad and upset and miss the second move. The number one goal is don't miss the second move, because that one, it has an even higher probability. So imagine the probability, I'll just make things up. Third week of August, 60% chance of a rally after the third week of August. So now I just have to confirm or deny when a rally happens. And if I can confirm it, I get in it. But I know even then it's mediocre. I don't know the outcome, but I know it's mediocre. So I'll adjust my attitude and my risk tolerance according to market conditions and probabilities. But if I had way more conviction for the third week of September, like I thought 85% chance this is going to turn into um, a multi-week risk on rally. Dude, there's no way in hell I'm going to miss that. Like, well, Wayne, why are you so confident? You just broke even on 25 trades. Yeah, well, that was then. If anything, my confidence level is built up. So now I just got to be cautious. Like if it double bottoms, that's not great. I'm not going to buy it because it's a double bottom. If September creates a lower low, that delays my timing, but not my confidence level, because it doesn't matter to me. Make a lower low. Well, I don't buy lower lows. I don't buy double bottoms. So I'm like, well, I can't wait. So now it's the fourth week of September. No entry. But I want to buy in the third week. Well, what you want is irrelevant. You're using your charts and your analysis to confirm or deny your trading hypothesis. This is what you get paid for. Hey, Wayne, what do you think the Fed's going to do next month? Dude, I'll tell you I'll tell you my data-driven hypotheses. That's your value proposition. So now let's say it's the first week of October. You've been waiting for 14 days for an entry. Well, I haven't got my higher high, higher low yet. And remember, I'm not trying to get a perfect entry. I'm not trying to pick a bottom. Think about this. Picking bottoms is a strategy that always stinks. Think of the joke. You want to base your life around picking bottoms? Gross. So how about confirming changes of trend based on probabilities and confirmed with technical analysis? Sounds way better, right? So now you're just sitting, waiting. And all of a sudden, the week over week pivot points go up. The buy zone goes up. It's in my book, right? You look at the change in the central pivot point, and last week was flat. This week, it pops up. Now what do? I'm buying a dip, bro. That's it. Game on. That's all I need. I have the probabilities. I have the timing. And now I'm confirming with the charts. Game on. So what's my buy zone? Now I have the price. Well, central pivot point to M2. Or the somewhere between the 21.55. Done. Now I got two sets of prices in which I'm going to buy. And I'm going to buy with confidence. And even if it took me 3 weeks to confirm it, now that it's happening, now I fire for effect because I am a strong, confident trader. That's the difference. And a scalper goes, I don't know what I'm doing. All I know is a moving average crossed over. All I know is I got some sort of trend line on a 12-minute chart, and I'm going to let this run 15 or 20 pips because I have no idea the context of the trade and will this last minutes or weeks? I don't know. Well, the problem with only making 25 pips a trade is that it doesn't add up to real money. So what do? You jack up your leverage, sucker, or you jack up your lot size. The difference only being whether you're rich or you're poor. If you have money, you don't need leverage. But if you're poor, you jack up on leverage. Either way, either scenario, huge lot sizes or huge leverage, you're going to lose all your money. A rich person doesn't care, and a poor person justifies it. Well, everybody loses money in Forex. The whole thing's a scam, and my broker hunts my stops. No, you suck. You didn't put the work in. The key is low leverage, low lot size, and having trades that are worth more, not in leverage or lot size, but in pips. letting the winner run, and then buying and adding to it on the next higher high, higher low, and then adding another one on the next higher high, higher low. All of a sudden, over the course of 5 weeks, you're just, every time it hits the 21 EMA, you buy another one and drop another stop. So you might have 5, 10, 15, 20 trades. And guess what? None of them are at risk because you got them all to break even before you added the next one. So you might have 25 trades open, and every trade at break even, you have 100% available margin, and you're letting your winners run. And those 25 trades, let's say together, average, come out as 1,000 pips. But you can't scalp 1,000 pips. That's the problem, right? Someone that only makes 100 pips a month and brags about it. Well, to make enough money to pay for your house and pay for your children and save for retirement, you got to have huge lot sizes on it, which means no, they're not doing any of those things. Yeah. My favorite is, the YouTubers that, make big money scalping, and they're like, look at me, I got a Lamborghini. I'm like, well, look at me, I got 2 kids in college, and that's worth more than your Lambo. Yeah. Yeah. And my kids are going to graduate with no debt. Boom. That's called wealthy. Leasing a Lambo is the dumbest idea on the planet, which leads to poverty, right? So this is big. What I'm telling you is, this is not just a cute little technique like, oh, I'm going to add some fundamentals in with my trading. This is like a huge game changer, like not just a revolution in trading, but a revolution in behavior and thinking process. I want you to think, how can you make 1,000 pips in September? And how can you make 1,000 pips in October? You're not going to do it scalping. And I mean profit. I got 1,000 pips negative. Whoa, whoa, whoa. So imagine the mind, okay? So to be able to do that right and afford it and not take on too much risk, you're going to need to drop your lot size, which is effectively dropping your leverage. 500 to 1 is not going to save you. If you can't make money at 50 to 1, you're just not a good trader. So what you need to do is drop your lot size but make more trades. Get in another one, get in another one, get in another one. Well, Wayne, how do I compound my trades? Well, you need to know when there's a trend and when the trend is probably going to end or probably start. And you're ready, willing, and able before it happens, not after. And so because you were able to, let's say, predict it or anticipate it, you're in a little earlier into the new trend. You're able, because you have smaller lot size, you have the confidence to take the trade. And then once you get it to break even, maybe later that day, maybe the next day, maybe there's day trades. Every day you add another one, move the stop to break even. And the next day, add another one, move the stop to break even. It's entirely possible. Like, for example, 30 week of September. So we'll call it, I'll just call it, so you're in for a week, then it's October. We'll call that 4 weeks. So that's 5 weeks. All of November. Okay. So now we're at 9 weeks, 2 weeks of December, 11 weeks. How many day trades could you compound in 11 weeks? 55, right? If you were long for 55 days on your first trade, how many pips did that make? And the second trade, you were long 54 days, and the other one 53 days. Could all of this add up to an average of 20 pips a day? Some are worth extraordinarily more. The ones you took recently are worth a lot less, but on average, does it add up to 20 pips? Times 55, you got 1,000 pips. Meanwhile, every single trade is taken when the first trade before it, the previous trade, already has removed risk, which means there's zero leverage on that now. There's zero risk. Your worst case scenario is not making money. Your best case scenario is making money every day for 11 weeks. Then the next one. And a day later, you log in, move your stop to break even, wait for the third trade, and on that third day, it finally comes back, boom. Okay. Then you log on the fourth day, move the third day to break even, and add the next one. And now we can get into interesting conversations like, when do you take profit and why? How do you manage your stops and why? Like, do you leave them at break even for 11 weeks, or do you trail a little bit? And how quickly do you trail? And what technique do you use to trail? Wayne, I like to use a 50 pip trailing stop. Dumb idea. Why don't you just make a decision? Okay. If you're going to do it that way, why not use PSAR and make it a volatility exit, not just some random price that you made up? Or how about on a lower low? Okay. Or what about a pivot target? Oh, if we get to the annual M4, I'm going to take profit. Makes sense to me. Or at least start moving stops closer and closer and closer, which is even better. But the thing is, you're not making these tiny little pissy little day trades. You're making 25 pips a trade. Dude, you're going to starve. What you need to know is why the trade is happening before it happens, and the probabilities for you or against you, so that you understand the context of on the chart what's happening. You can do this. You can make better trades, not necessarily more pips or anything. That's not what we're talking about. What we're talking about is doing better analysis, trading with the institutional investors, trading with probabilities. Like, every trade you make probably will make money. Not necessarily, but probably. Yeah. And then probably when that's likely to end. And now you're using technical analysis and fundamental analysis to confirm or deny that it's time to get in or it's time to get out. What happens is you're trading, and your decision-making process is more valuable. There's more value associated with all your trading because better decisions were made. You were more informed than the other person on the other side of your trade. You're a better trader. Yeah. And if you buy in the idea, like, look, if you want to get to that next level of a trader, you need to be in your trades a lot longer. And for that, you need to know. You need to know. You need to be a knowledgeable person based on facts. Okay? You see? Okay? It's cool, right? It's cool, and it's also necessary. So let's take a look at that COT then. We'll start with currencies. Peso still long. Why? They need carry. Okay. The market is short Japanese yen. I would expect on on Friday that this is going to turn green, green, green. Why? There was an earthquake in Japan, and I know how to make money. What if there's an earthquake in Chile? Are you buying copper? How long is it going to take you to figure out to buy copper? Chi, 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 lay, lay, lay. What else do we see here? The market is selling Kiwi, selling CAD, selling Yen. Okay, and everything is fairly neutral. Okay, but look at that. Going heavy long. Yeah. So not much action going on in Forex, but we've seen it really quiet, really slow, low vol for quite some time in Forex. But these bearish positioning have not changed in months now. Okay, what is being traded? Sell, 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 buy. It's been like that for months, and by and large, it's staying that way. But we know we're having a seasonal change soon. And are you ready for this to continue or change? Well, part of that is you have to say, well, if the Fed's going to raise interest rates in September, the US dollar is going to get strong, the US dollar is going to get strong, and it's going to kill this carry. So you could have a hypothesis, because I don't know what you think, but you look at the yield curve and you say, oh, institutions are pricing in a high percentage chance of a September hike. That would probably increase the value of the dollar. That would then make less of a carry on peso. Plus, Mexico has a lot of dollar debt, so that means their debt service costs are going to go up, and that's going to hurt the Mexican economy. Okay, cool. So no major changes there. Ethereum, we already did. Look, we know over the several months, we have known and we have seen and we have witnessed that the market is heavily bearish on crypto. But for some reason last week, they bought a boatload of Ethereum, which we also knew was extraordinarily high in probability to happen, and we crushed it. Okay, cool. I don't think that's going to last anymore, and that's why we have a seasonal charts. Indices, cool. NASI did well. S&P 500 okay. Why? Because the VIX fell. Cool. But you haven't even seen anything yet. A bullish week in NASDAQ, whatever, it's still bearish. But I would look, if I were me, at the end of August and certainly by the end of September for these to go from red to green. And if they do, I'm long and strong. Okay? And not just my Forex trading, but my pension trading, my endowment trading. It's all built into this seasonality. When to buy, when to hedge, when to go to cash, when to reallocate, when to rebalance. It's all based on this type of information. So you're like, I'm waiting to buy NASDAQ. Okay. These might be indicators and these might be confirmation. Think of this as, weekly pivots, monthly pivots. Yeah. This is going to turn and then that first, and then that's going to turn second. But what I would say to myself is that I don't expect a major change in NASDAQ now based on seasonal analysis. Cool. This is early, but it's happened. Cool. Maybe this year's different than the last. Cool. Well, I'll have technical analysis to confirm that. Do you want to do the tech now? Let's do the tech now. It's so easy when everybody's trying to please me, baby. Like, Wayne, you just show me what to do. All right. Wayne, you talk too much. Well, I preach to teach, or you don't listen enough. I might talk too much, but maybe you don't listen enough. If that's your thought. So, is it time for the big rally? Okay. The big rally? Maybe. I think you might be early for the big rally. Okay. Maybe, right? Is it possible it goes bullish? Maybe. So let's change this now. Indicators, biased pivots. We want bullish mode. Boop. Okay. And so now you should be watching this chart. When do you feel bullish? You see the difference in attitude and analysis? Okay. Is this buyable? No, it's not. It's not. You're like, but Wayne, it's rallied since 29th. Uh-huh. Cool. What is that, 2 days? You're now bullish because of a 2-day rally? Well, Wayne, I stare at a 15-minute chart all day, so 2 days is a lifetime. No, not. I don't think you stay in trades for 2 days. So, okay. So what would Wayne need to see here before the Wayne goes long? I love the third-party reference, by the way. The Donald, the Wayne, Ditka. What do I need to see? Help me out. Teach me how to trade. See, imagine the scenario in which we thought this could be right about the correct time for a bullish trend to appear. Now, I don't believe it's the case, but just imagine it was the case. Can I buy this if I thought it was going to be bullish? No. Why not? I don't like the moving averages. I don't like the pivot points. I don't like the COT. So I can look at this and say, hey, if you're on a small time frame, it looks bullish, right? Let's see if I can even get this to be bullish. So a bull would want to buy this, right? Yeah, not me. Not me. I have clear decisions. If you're not sure and you find ambiguity in your trading, well, then your trading is also suffering from mediocrity because you don't understand the situation in which you stand. You're on trial every trade. If you're a professional trader, this trade you're about to make goes on your history for 5 years. Every trade you make, you're on trial. So is it going to be for fun? Is it going to be random? Is this like Fortnite? Yeah, Lucas, that's a major one. Yeah, that's a major one. Lucas, absolutely, totally true. I look at this, I'm like, not me. Hey, Lucas, it's an extraordinarily warm day in February. Should you go out there and plant some sorghum seed? You're like, I get it. It's a warm day. Probably not the right time to plant some sorghum seed, though. I think I'm going to wait till, I don't know, third week of April. Third week of February is not good. I see it's warm today, but the probability of it staying warm is low. So you don't react to short-term random stuff, but you stick to historic norms that keep you out of trouble more than they put you into opportunity. They protect you from threat. And if you're going to be in this trading business for 30 years, guys, you're more interested in the threat than the opportunity. The way I manage my endowments is financial engineering. Think of it like extraordinarily, I guess, narrowed standard deviation compared to a traditional 60-40 portfolio that a retiree might be in. Or someone that is 90% stocks. And they're like, I got to be in NASDAQ because it's going up 25% a year. I'm like, okay, great. What's the standard deviation on that? It's huge. So why would I want a narrow standard deviation compared to these other ways to construct a portfolio? Because I know with much, much, much higher probability, even though I never know the future, but based on quantitative analysis, the likely outcome of 10, 15, 20 years in advance, right? I know with much greater certainty. Now, past performance does not predict future results, but quantitatively, I have a much higher confidence level or certainty level of where the account will be on year 21. Now, imagine you're a scalper and you don't know what you're doing. Every day is a new day. You don't know if it's risk on or risk off. You don't know if this trade's going to last 2 hours, 2 days, 2 weeks, 2 months. You have no idea. What's your account going to be in 5 years? What's your Sharpe ratio? What's your Sortino ratio? You don't know these things. You're a random walk down Wall Street. And if you read that stupid book, you know, the analogy is a drunk person walking down this Wall Street. They're all over the place. They're left and right. They're up and down. They're walking into telephone poles. They're a drunken, bloody mess. Well, that's you trading. We don't like that. That's not good. That's not a good image. And I want you to succeed. I want you to bring value to what you do. I want you to take care of you and your family, and then your neighbors and your community. Okay? I manage charitable endowments because I can, because it's a moral imperative, If you know how to trade and invest properly, it's a moral imperative for you to serve your community. But if you're a filthy, drunken, random mess walking down Wall Street, you're a hazard and an embarrassment to your community and your loved ones. Oh, well, then we need to change that, right? Yeah. Increasing value, lowering risk, using probabilities, and using technical analysis in context with real market conditions, not just technical analysis. So we can say, oh, well, everybody's talking about the Fed's going to raise interest rates. You're like, oh, well, let me go check that out. Oops, clicked on the wrong one. Well, hey, I guess it's an ad. Your broker can pay for your everything for you. All right, let's go to what was I going to do? Oh, fundamentals, econ, rates radar. And 62% chance they're going to raise interest rates in September. Thank you, H2O producer. I got a lot of feedback from people to kind of mix them up. See, in my mind, technical analysis is by far the easiest thing. Like buy a higher low. What's the problem? Right? Oh, you're a bear? Sell a lower high. What's the problem? So I forget. And so people give me feedback and ask questions. I'm like, oh, well, I can do that. To me, knowing how and when or why and when to be a bull or a bear is much more interesting. But I get the feedback. I'm like, okay, well, yeah, I can pull up a chart. It's not a problem. So, like I said in this previous example, what if I was a bull on NASDAQ? Well, I am a bull. Do I know when NASDAQ's likely to resume an uptrend? Yeah. Is it now? No. But even if it was now, is this the time to buy? We had this huge rally at the end of July. No, it's not. Is this the right technical environment for me to buy? No, it is not. See how the clarity? I want you to trade with clarity. Like, I get it. It rallied for 2 days. Seems hopeful, right? I have no hope. I'm hopeless. I know with precision what and when. Okay. I'm a bull. Great. When? Not now. I can do the when using fundamentals. I can do when with technicals, but the honest truth, I use both. Okay. And we have data to be quite precise. So snipers have to know how to fire their weapon and practice like crazy. Part of that, you probably know, they have to adjust their scope and their aim according to the wind. You probably know that. Do you know what the Coriolis effect is? It's adjusting for the rotation of the earth. Yes, the spin of the earth. If you're firing far enough, the earth is rotating. The target is moving. So the wind pushes the bullet, but the earth spinning moves the target. So you have to adjust for that. Not if you're shooting 50 yards, but if you're shooting on the other side of the valley. And so do you have the precision for that? Yeah, for sure. Okay. This is a great way. Love the new combination, technicals and fundamentals. Is exactly what I was dreaming about. I remember a trainer is always behind the client. That's working out to spot. I'm telling you that everyone would benefit. Watching you work it out makes sense. You're the rock. Then execute. Yeah, well, my execution here is holding cash. Yeah. Okay. But like, look, I set my pivot points bullish, right? I want you to understand, like Lucas, for example, had no problem with this question. I'm a bull. Is this a bullish setup? Lucas is like, no. I agree with Lucas. Nope. I'm a bull for sure. Now, seasonality says it's not the right time, but maybe it is. Maybe it's different this year. I'm okay with that. Doesn't change the technical outlook. And if you don't understand why this is not bullish, despite the high relative to that one, despite the big 3-day rally, if you don't understand, it's because you don't know how to trade properly. That's just a deficiency. We do have a 100-hour training course for $88. It's at Investor Bootcamp. And like, if you don't know how to trade, then like this whole conversation is moot. You're like, how come I'm not making money? Because your trades suck. You don't even know how to do technical analysis? Really? I'm assuming you know how to do technical analysis, right? Cool. So is this a buy? No. Come back in a week. Right? So fundamentally, it's like probably not now. Technically, well, that's not bullish. If we get closer to the third week of August and I see a technical trade, this is not bullish. If I saw a technical opportunity confirming maybe a maybe time period of maybe up, and I do get a technical up, I will take a trade. It'll be small. I won't have a lot of faith in it, but it is better. And I understand even if I get in the trade and I make money and then it collapses on me and breaks even, I'll say, well, I knew it was early, but I had the technical opportunity, so I took it. But fundamentally, it was early. But I'm still going to take it because sometimes, every once in a while, the trades I take in August last all the way to December. I just don't know. And I'm willing to tell you, I just don't know. Is it going to be the second week of August? Is it going to be the third? Is it going to be the fourth? Is it not August at all? Is it going to be the third week of September? Is it going to be like, I don't know. I just know there's a couple of windows coming up based on normality, and I'm going to confirm and deny with technical analysis. So if it said, hey, maybe this is the week it goes bullish, I'm like, well, it's not bullish now, so pass. Yeah, I still have a lot of screens, Ray, but the other thing for the US, we use a different execution partner, but it's inside the platform, so not a problem. You could be up and running in 20 minutes with the trading account with our execution partner. Yeah. They have incredibly fast onboarding. It's awesome. So anyways, so that's it. I want you to hear the certainty in my voice and also not translate that to arrogance. I'm not being arrogant. I'm being decisive. I have that level of clarity. I don't know if it's going to work. I don't know if I am going to make money or not. I do know exactly what I'm looking for and exactly what I intend to do. I know probabilities of those successes, but I'm also always going to manage to be risk adverse first. And then the second thing is to let the winners run. And now to do all of that, that's where I need data. You're only as good as your data. If you're making this up, if you're a random walk in a market you believe is a random walk, because it must be random for you if you have no data. So your randomness inside of what seems to be randomness to you, the math will tell you 99.99% you're going to fail. Random inside a random doesn't mean steady profit. Now, if you're like, I don't believe in any of the fundamental hocus pocus, and Wayne, I know you've done 20 years of analysis to do probability, but I don't believe any of it. Fine. Then you're still going to come down to one thing. You need to be consistent in a market that feels random to you. Because if you're ignoring all the data, then it will seem random. Okay, fine. You can still make money if you're consistent. And this is what I was teaching you guys last week. Let's say you're a dollar bull. Or let's say you're a yen bear. Yen strong right now. Do you sell yen? No. What about tomorrow? What if it's strong tomorrow? Do you sell yen? No. You could go 3, 4, 5, 6, 7, 8 weeks in a row in which yen is strong, or at least not weak. Fine. Don't do anything. Do you have the patience and discipline? But then one day, and I have some numbers to tell you when it will probably happen, but you don't believe in mathematics and historic research. You don't believe in any of that. So you'll just wait. But one day you wake up, you don't know if it's week 2 or week 9, but one day you wake up and the yen is weak. Then you'll start buying dips on things like pound yen, euro yen, Aussie yen, Kiwi yen, dollar yen. Now, I also know if you're correct on your timing on yen weakness, I know how long it's going to last. Oh my God. So if you can get that right, it could be months and months and months in which you are simply buying higher lows in pound yen, buying higher lows in Aussie yen, buying higher lows in Kiwi yen, buying higher lows in dollar yen, so on and so forth. Can you buy? Are you capable of buying higher lows in CAD yen? So to me, from a technical point of view, dude, really? That's like, oh my God, that is so basic. Like you can learn how to do that in a day. But if you're patient and disciplined to say, I only buy yen pairs, which is the equivalent of selling the Japanese yen, and you're making a synthetic index. So if you're buying pound yen, Aussie yen, Kiwi yen, CAD yen, dollar yen, whatever yen, all you're doing is making a synthetic yen short basket and collecting the carry and net asset value appreciation. Cool. I get it. Sounds good. But buying a higher low, like, dude, how hard can that possibly be? You don't need any indicators to do that. You don't need moving averages. You don't need pivot points. You don't need oscillators. Now, some of these things are very helpful to identify a higher low. But if that's all you did, one at a time, move your stop to break it, you'd make money. You'd be consistent. You'd be patient. You'd be disciplined. Now, you have no idea when it's going to show up, and you have no idea when it's going to stop, but you do the technical analysis so well that you see it on your chart a little after the fact. You can't anticipate when it's going to happen, so you would have to wait for things to already turn bearish for the yen and then react, but at least you recognize it, and you're always going to be in it a little too long because you don't know when it's going to stop. So you're going to be a little late taking profit, but whatever, you're still going to be quite good. And you're patient, you're disciplined, you're consistent, you're confident. This is great. You'll be a great trader. I would say a little bit of technical analysis would help you with your entries and exits, things like pivot points. I think using some of the fundamentals, some of the seasonality, some of the COT, some sort of combination, but having some fundamental quantitative macro analysis would also improve your trading. I think you got this. So it comes down to, are you changing your old ways, and are you doing the work? And that's the part people don't like, right? Because they're like, dude, it hurts. But tell me, you know how to buy a higher low on a chart. Or like, if you don't know why I say this is not bullish, then you need to go back and learn how to trade. You could probably fix that in a morning. Investorbootcamp.com. Let me just put that down there. That's a huge sales pitch. I'm going to get filthy, stinking rich selling you courses for 100 hours for $88. I'm going to get filthy, stinking rich. Investor Bootcamp. Yeah, you try recording 100 hours. Okay. So you pay $88, you're fixed by tomorrow. Now, what's the problem? Give me a problem I can't solve. Okay. Look, I understand life is complicated. You got 9 kids, you're in a godforsaken country and all these things, but there, other people have it worse than you or harder than you. There's someone out there with 10 kids who still can trade Forex. There's someone out there with 5 jobs but can still trade Forex. They can still know how to trade a pivot point or a higher low. Okay. Yeah. Somebody's got it harder than you. There's no excuse. Yeah. So look, you need to be a hero. It's just that simple. A hero for yourself, so you feel proud of what you are capable of. And then you need to create a track record of success to prove to others that not only are you capable, but you are a hero. And then you need to help your friends, your family, your loved ones, your neighbor, your community. Okay, take care of your church's money, get them right. Okay. I'm creating a program for churches to participate in my endowment because I know a few that suddenly have about the right amount of money and they need help. So I'm like, yeah, sure. But at some point, you need to step up. You have a moral duty. Okay, Dr. Dre, I started 2 hours ago explaining my thought on the Japanese yen. That was the first thing I talked about, Dre. Come on, Dre, every day. Down on the pet, right down in my lab with my pen and my pad. Yeah. Okay. Ray, why don't you click buttons and figure it out? Easy peasy. All right, everybody. Look, I want you to be the hero. I want you to be capable of being the hero. I sometimes beg, sometimes I cheer, sometimes I slap you on the butt, sometimes I slap you in the face, sometimes I prop you up, sometimes I insult you. I need you to get emotional. I need you to get mad. if you're not achieving your destiny. Let me say it a different way. We're only a few weeks out to the best time of the year. And if you're mediocre now, why should you be excellent then? So if you find yourself in mediocrity, we need to figure that out. Now, the markets are mediocre, so most of your trading should be mediocre. It should be few and far between. You should be conservative. You should be building up cash positions. Your trading should be less than normal. But if you don't adapt to changing market conditions because you don't know or you don't do the analysis, what I found is this is the worst period of the year for me. In the old days, this is when I'd lose money. You understand? Because you're trading like we traded in May. Well, what the heck, dude? Wake up. It's not May. This is August, bro. Okay? You're in May and June? Dude. Okay? So this is where you need to step up now, figure out what you're going to do to be a better trader. By the time we get to the end of September, I need it. Think of it as playoffs. Dude, are you going to be ready for the playoffs? Or are you going to walk in fat and lazy? Are you competitive enough? Are you going to step up? Are you a champion, or you just like to pretend you're a champion? Yeah. Yeah. You could be the champion. You could be the best. You could be King Kong pounding on your chest. Or is it just talk? Yeah. This is where, so this is, you got to be psychologically, physically, mentally, emotionally ready to kick some ass going into the fourth quarter. But you're not going to do it if you're a sloth now. So take the opportunity to step up in any way that you think it is, whether it's consistency, confidence, using the platform to do analytical research better, start using seasonality better, start figuring out how to use COT better, figure out how to use the risk radars better, start to use hey, do you see how this might, this might increase the value of the dollar, but if this starts dropping from 63 to 56 to 52 to 48 to 39, that the US dollar will weaken. Do you even track the yield curve? I thought you wanted to be a boss. I thought you wanted to trade like an institutional investor. You need to know how to use yield curve. Okay. Look what's happening here. Something is radically changing recently. What does it mean, Basel? Okay. If you don't look at this and immediately say, oh my God, just a few days ago, it was well over 101 and now we drop below 100. If that doesn't slap you in the face, then you need to step up your game. Yeah. Yeah. So when I ask you, are you risk on? Some of you said you're risk off. You don't know what's going on. Clueless. There's risk off and very risk off. You guys have no idea what you're doing. That's not the market conditions. If you analyze 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Times 3. Okay. 48 calculations were made today, made throughout the day. 48 calculations being made every few minutes, and you're risk off or very risk off. I'm doing more work. This is not a feeling. This is analyzing the attractiveness of junk bonds, weighted and balanced over 3 time frames, like legit. So how would you like your ambiguity to just go away? You log in, you're like, oh, things are improving. Risk on. You need to get better at that. Like, it's just those types of things. Like, you're risk off or very risk off. You don't know what's going on in the market compared to the entire aggregate of the entire industry, including institutional investors and retail. But, retail investors don't really trade junk bonds or 2-year yields, right? They're not trading the 210 spread. They're not tracking the put call ratio. We are. You should be. So if you came in today and you're like, we're very risk off, you're not doing those things and you're not making good calculations. And you're like, well, I trade euro dollar every day and it looks risk off. Okay. Okay. I do 48 calculations in real time using all markets, and you're going by gut feeling. You're not competitive. You're not going to be a franchise player on a playoff team. You don't have a chance at the championship. There's just no way you're going to compete. You might get lucky today, but you're not going to get lucky every day. Like that kind of stuff. And again, I want to make sure I'm not talking down to you. I'm lifting you up, either through inspiration or by making you mad. But if you're that far off, you should be mad. Not mad at me, mad at yourself. And you either quit or you step up. And in this game, my friend, this is a step up game. Okay? You see what I mean? So thank you for being on my team. Thank you for being part of the community. I hope you understand that I preach to teach. I'm also preaching to myself. I want you to succeed. I want you to step up. I want you to say, you know what, Wayne? You're right. And I'm changing everything today. First trading day of August. And by October 1st, I need to be prime time, playoff ready, peak performance, physically, emotionally, psychologically. Your IQ, your EQ, it's all set to win. And by then, you've built the right habits and the right confidence that October, November, and December are going to be incredibly important to your year-end results. And by the time we get to the end of December and beginning of January, it's a completely different world. And if you try that crap that you did in December, in January, you're going to be sorely disappointed because you're doing something that used to work in a market that's radically different. And once again, you have to know that. And if you don't know that, then if you got lucky in October, November, December, don't worry about it. You're going to give it back in January, February, March, because you just don't know what's going on. That's why having quantitative analysis is important. So what I'm preparing you for isn't going to work now. I'm preparing for you because it's going to work in the future, but then further out in the future, that will no longer work. And you have to understand that there are cycles. And so not everything is a moving average crossover. So do it for your destiny, do it for your family, do it for your community. Everybody needs you to be a hero. So step up. Huh? Put your Lululemons on and your cape and be the superhero you need to be, because nobody else is even going to try. So it'd be a terrible, terrible disappointment if you were capable of being a hero. You were just lazy. Huh? Oh, you were a Forex trader once, but my trader, my broker hunted all my stops. No, what you should be telling the story of is how you had a chance, but you dropped the ball. Drowned in a sea of mediocrity. And you refused to swim to the shore. Peace on earth. May the pips be with you. May your profits be above average. I'll see you later today. Hey, right? Yeah. I'll see you later today. Yeah, Richard, it's a different game. Yeah. January is not the same as November. Not even close. And March, don't even get me. I'm ready for March. And I'm ready for April of 2027. I know what I want to do at the end of September. I know what I want to do in October. I know when to feel confident in November, but also when I lose confidence in November. I know if I've been blessed enough to stay in my trades, what day to start taking profit in December. I know this data already. Do you?